It's unsustainable. The data are practically yelling that it can't last, yet nobody seems to hear them. Hey, I'm Gregory Hale. For 17 years, I've been chasing the fissures in the U.S. financial machine, think shadow bank fallout and the corporate debt balloon. Now I'm staring at something that dwarfs all of those past messes. A market held up by borrowed money, wild speculation, and plain stubbornness. And that market is beginning to shudder. In this clip, you'll watch the American housing dream morph into a flimsy house of cards. How families who believed they'd bought security actually bought a ticking time bomb. And when that imbalance finally snaps, it won't be only investors who get knocked down, millions of homeowners will get hit as well. The truth is, the headlines are off the mark. They'll tell you mortgage rates are climbing. They'll say the market is cooling off. But they're overlooking the real story. It's the story unfolding in mid-sized towns from Ohio to Iowa, where for sale signs flash like warning lights and nobody's looking. They're calling it a correction. But it's not. The S&P/Case-Shiller U.S. National Home Price Index just logged its first yearly decline in more than 10 years. It fell 4.2% in Q2 2023. That's not a dip. That's a stall, a screeching halt. And it's not just the coasts, it's the heartland too. The Midwest just watched median home values tumble 5% in a single year. From Ohio to Iowa, the zones where affordability once reigned are now ground zero. It's happening everywhere. The 2023 Housing Vacancy Survey just landed, showing a 2.3% surge in vacant homes across the country. The biggest rise in a decade. Empty houses, unpaid mortgages, and behind each one, a tale of borrowed time. But here's what the news won't say. This isn't just about supply and demand any longer. It's about leverage. It's about risk sitting in plain view. Take a major mortgage REIT, for instance. In its 2022 annual filing, it revealed a 30% jump in loans where borrowers put down under 10%. High-LTV loans, the kind that survive only while prices keep climbing, the kind that become underwater nightmares the instant the music stops. We're looking at a housing market that's been called everything from overheated to unsustainable. But why? Because behind the headlines about interest rates, there's another story, one of speculative flips, relaxed lending, and rising exposure to debt that most people never see. This isn't just about prices going up and down. It's about how the system itself has been rewired. Source: Federal Reserve Economic Data, FRED. S&P Case-Shiller U.S. National Home Price Index shows a 4.2% year-over-year decline in Q2 2023, the first annual drop since 2012. And yet, during the same period, flipping activity surged in markets you'd least expect. Not just coastal cities, but in mid-sized metros where prices once moved slowly. Places like Boise, Spokane, and Greensboro saw flip volume double between 2021 and 2023. These weren't speculative gambles on million-dollar homes. They were bets on modest starter homes that families need, not luxury buyers want. Mid-sized markets like Boise, ID, Spokane, WA, and Greensboro, NC saw flip volume increase over 100% from 2021 to 2023. Source: ATTOM Data Solutions, analyzed via public property records. Take Boise, Idaho. In 2021, fewer than 500 homes were flipped. By 2023, that number exceeded 1,200. The median flip profit, $85,000. But here's the catch. Most of those flips relied on short-term financing, bridge loans, private lenders, or lines of credit that reset every 12 to 24 months. Borrowers weren't banking on long-term appreciation. They were banking on the ability to sell fast before the interest came due. Most flippers weren't holding inventory for years. They were recycling capital every 90 days. ATTOM Data Solutions, 2023 Market Report. Now, compare that to the interest rate narrative that dominates the news. Headlines scream about the Fed raising rates. Analysts warn of mortgage lock-in. Brokers tell buyers to wait. But while the cost of borrowing has risen, the real engine of this market wasn't the 30-year fixed mortgage. It was the underwriting standards that quietly loosened standards that allowed investors to buy in bulk, with minimal documentation and minimal equity. Footage of investor groups touring single-family homes in bulk, followed by contract signings in office parks, no retail buyers in sight. We spoke with a mortgage underwriter who worked at one of the largest non-bank lenders in the Midwest. They asked to remain anonymous, but they described a system where stated income loans, once restricted to self-employed professionals, returned under new names like investor cash flow loans. We had clients buying 10 homes at once with 10% down, using projected rental income to qualify. No tax returns, no debt-to-income verification. Just a spreadsheet and a promise. Source: Underwriter interview conducted April 2024. Title: and employer withheld for confidentiality. That's not how homeownership has been defined for decades. That's how speculation thrives, and the numbers back it up. In its 2022 Form 10-K, a major mortgage REIT disclosed a 30% increase in its loan portfolio exposure to high-LTV residential loans, loans where borrowers put down less than 20%, and in many cases, less than 10%. That's not margin debt. That's not corporate leverage. That's household leverage spread across thousands of investors who now depend on the market staying frothy. Beat text pop. Portfolio exposure to high-LTV loans rose 30% in 2022, outpacing growth in traditional mortgages. SEC filing, 2022 Form 10-K, Major Mortgage REIT. Now let's talk about what this means in reality, because when prices stop rising, and they have, the math breaks. The New York Times reported in September 2023 that mortgage applications fell 15% in August, the steepest single-month drop since the 2008 crisis. But that wasn't just buyers backing out. It was lenders tightening. And when lenders tighten, flippers can't refinance. They can't sell. They can't roll over their loans. Beat visual. Charts from the New York Times showing mortgage application volume collapsing in August 2023 with a 15% month-to-month decline. At the same time, vacancy rates are climbing. The U.S. Census Bureau's 2023 Housing Vacancy Survey shows a 2.3% increase in vacant units nationwide, the largest rise in a decade. That's not just seasonal turnover. That's supply that's stuck. Homes that can't be sold. Investors who can't exit. Beat text pop. Vacant units increased 2.3% in 2023, the largest jump in 10 years. U.S. Census Bureau, Housing Vacancy Survey 2023. So where does this lead? We spoke with a housing economist at a major university who crunched the numbers on hidden debt exposure. They found that nearly 20% of all single-family rental properties purchased since 2020 were financed with adjustable rate or interest-only loans, products designed for short-term cash flow, not long-term affordability. Beat tonal. What we're seeing is a shadow layer of debt that's directly tied to speculative activity, not to homebuyer fundamentals. Source: Housing Economist interview conducted March 2024. Affiliation withheld for confidentiality. That debt sits on balance sheets that most Americans never see. It's not in the national mortgage delinquency rate. It's not in the Case-Shiller Index. It's in private loan books, in securitized rental portfolios, in the balance sheets of firms that aren't required to report like banks. And here's the paradox. As prices fall, Case-Shiller shows a 4.2% drop in Q2 2023, the first annual decline since 2012. This hidden debt doesn't disappear. It becomes heavier, because the loans were taken when values were higher, because the exit strategy was always a sale, and because the system allowed it until it didn't. Beat visual. Split screen. One side showing rising flip counts from 2021, 2023, the other showing falling Case-Shiller index and rising vacancy rates. So what happens next? That's the question we're chasing. Because the market isn't crashing today. But the ingredients are in place. Lax underwriting, high exposure, rising vacancies, declining prices, and a generation of investors who bought not because they wanted to live in these homes, but because they thought they could flip them for a profit. And that's where the story turns from data to risk. Because in the end, housing isn't just shelter, it's leverage. And when leverage outruns stability, the system doesn't just cool down, it freezes. So the numbers on the screen just stop rising. Instead, they start to tilt. And that tilt widens into a gap that no analyst can ignore. It's like pretty hard to miss. A line graph of the S&P/Case-Shiller index snaps from a gradual climb to a sharp dip, the red bar flashing 4.2% YoY in Q2 2023, the first annual decline since 2012, by the way. Source: FRED. But here's the thing. That single drop is a symptom, not the disease. Across the Midwest, median home values have already slipped 5% between Q1 and Q3 of 2023, according to the FHFA House Price Index. Source: FHFA. The data points alone suggest a market that is losing its footing, but the real danger lies beneath the surface. It's like, what you don't see can hurt you. Underwriting standards now, that's a key term to watch. A senior economist at a leading think tank ran a stress test simulation that tightened loan-to-value caps by just 5 percentage points. The model projected a 15–20% plunge in national home prices within 12 months, provided lenders pull back on credit as quickly as they have in the past. The simulation doesn't claim certainty. It simply asks what happens when the safety nets disappear. A pretty important question. The simulation's output shows a cascading effect. Fewer qualified buyers, slower sales, and a feedback loop that drags prices down faster than the market has seen in any post-war decade. It's like a domino effect. One thing falls, and everything else follows. On the ground, the warning signs are already audible. In a mid-sized city in the Midwest, a council member stood in front of a row of empty storefronts and said, "We're seeing vacancy rates climb, rents inching lower, and the first wave of foreclosures hitting families who thought they were safe." The 2023 Housing Vacancy Survey confirms the trend, reporting a 2.3% rise in vacant units nationwide, the biggest jump in 10 years, by the way. Source: Census. "It feels like we're watching a pressure cooker lose its lid," the council member added, gesturing toward a shuttered apartment building. "The numbers are still modest, but the direction is unmistakable. You can't ignore the writing on the wall." Behind the public statements, a different narrative is playing out inside a major mortgage REIT's boardroom. A leaked internal memo, obtained by the documentary team, acknowledges the exposure. The REIT's 2022 Form 10-K shows a 30% increase in its loan portfolio tied to high-LTV residential mortgages. Source: SEC. Yet the same memo instructs senior executives to maintain confidence in the market and to avoid alarmist language in earnings calls. It's like a mixed message. The memo's tone is a study in contrast. While the data sheets whisper of risk, the public commentary insists that the market remains resilient. That's quite a disconnect. The disconnect is not just rhetorical. It is a strategic choice that could delay corrective action until the correction itself becomes catastrophic. A pretty big risk. A split screen shows the memo's highlighted paragraph on one side and the REIT's glossy investor presentation on the other, the latter proclaiming steady growth amid a solid housing backdrop. It's like two different stories. Meanwhile, consumer behavior is already shifting. Mortgage applications fell 15% in August 2023, the steepest month-to-month decline since the 2008 crisis, by the way. Source: NYT. Prospective buyers are pausing, lenders are tightening, and sellers are feeling the pressure. It's like a perfect storm brewing. The convergence of these forces, tightening credit, rising vacancies, and a slowdown in buyer demand, creates a perfect storm. If underwriting standards continue to tighten, the simulation's 15–20% price drop is no longer a hypothetical. It becomes a plausible trajectory, one that would erase years of home price gains in a single year. I mean, that's a pretty significant drop. The camera pulls back to a suburban street lined with "for sale" signs. One sign flashes "for sale" in bold letters. A second later, the same sign flips to "sold," then in rapid fast-forward morphs into "foreclosed." It's like a timeline of trouble. The transformation is stark, the timeline compressed, and the implication unmistakable. The narrator's voice drops to a low, urgent timbre. What began as a modest correction could, under tighter credit, become a rapid collapse. The data tells us the pressure is building. The question is how long before the market gives way. I mean, it's like we're waiting for the other shoe to drop. The screen fades to black, leaving only the echo of the last sign change. A reminder that the housing market's next chapter is already being written, page by page, by policies, by vacancies, and by the choices of lenders who can either brace for the fall or perhaps accelerate it. You know, the future is uncertain. That drop in the S&P/Case-Shiller U.S. National Home Price Index, it's 4.2% off from the same quarter last year, the first yearly fall since 2012. Source: isn't just another blip on the screen. It's a real pivot that's about to jostle three big crowds. First-time buyers. They were barely scraping by when homes were scarce, and now vacant units are up 2.3%, the biggest bump in 10 years. Source: more empty houses might push sellers to cut prices, yet lenders are pulling back, so newcomers are stuck choosing between bigger down payments or loans that stretch for years. Retirees, who have long counted on home equity as their safety net, watch that net shrink. In the Midwest, median home values slid 5% from January to September 2023. Source: erasing billions from the net worth of older owners who bought at the top. Investors, especially the ones tangled in mortgage-backed securities, feel the squeeze after a major REIT reported a 30% jump in high loan-to-value exposure. Source: toss in a 15% dive in mortgage applications last August, the steepest monthly slide since 2008. Source: and the math just flipped. So what's a smart move right now? 3 quick actions to keep in mind. 1. Double-check your loan paperwork. Even a tiny rate bump can tack hundreds onto your monthly bill. Refinancing or locking into a fixed rate might shield you from the next surge. Don't forget to peek at prepayment fees and line up APRs side by side. Those little extras add up fast. 2. Spread your bets. If your net worth is tied to one house, think about slicing the risk with REITs, index funds, or anything outside real estate. A mixed bag softens the blow when your neighborhood hits a rough patch. Even a small slice of diversified holdings can calm the ride when prices start to wobble. 3. Keep tabs on what's happening right where you live. National numbers are fine, but the real story lives in local vacancy stats, closed deals, and tightening rules from lenders. Often, those hyper-local pockets stay strong even when the big picture sours. Set up alerts for municipal property filings or fire up county GIS maps to watch your block. Want the full picture? The documentary below breaks down the raw data, chats with the experts, and runs the numbers so you can see both the big picture and the real people behind the trends. Markets love to swing, but if you act early, today's uncertainty can turn into tomorrow's upside. Found this useful? Hit subscribe, Pass the clip to anyone tracking the market, and tell us in the comments how you're bracing for whatever comes next in America's housing saga.